of wholesale, how they work, how inventory works, is essential in trading futures. And in equities, it's essential that you know who the insiders are and what their game plan for a stock is. Just little things like, for example, if you looked at that stock PLTR, right? People are going long that stock based on the business model. However, the insiders have gifted themselves 1.3 billion shares of free stock. So, I mean, how could you move a stock higher if you have 1.3 billion shares of stock at a zero cost basis being sold in your face all the time? It's impossible to move the stock higher. So, just things like that, those little things will really keep you in good stead if you're an investor, if you're a trader, no matter what you're doing. Now, for me, coming into the market, retail trading is the hardest thing I've ever had to do. And that's because it requires discipline. And when you're on the other side and you're actually controlling the order flow, you don't have to worry about discipline and you don't have to worry about um, you don't have to worry about risk limits and things like that. Because you put, if I wanted a stock to go up, I'll move it up. If I want a stock to go down, I'll move it down, depending on what our agenda is. If I need to flush out someone who has 5 million shares of stock, I'll hold the stock under a certain price and get that person out of the stock or that fund or whoever wants to get out at the prices we want, right? Now, when you're in a retail trading situation, none of that happens, right? You are completely beholden to the market and you have to really, really learn how to manage risk, have a trade plan, be disciplined, all of those things, do research, do a lot of that sort of thing, and sit and watch price action. And that was kind of hard because institutional traders, when the markets close, we go to the bar. Retail traders, when the markets close, that's when you start doing your hard work and your research because execution is the sort of the last, that's the last sort of step in the whole thing, right? So, we find that a lot of research, a lot of hard work, and a lot of time. I mean, I spent the one good thing is, I'm South Asian, I'm Sri Lankan, so my mom's 85 years old, and I had to go back to a place called Saskatchewan to look after her because that's where I grew up. And that place is like minus 50, like 10 months out of the year almost. So there's really nothing to do except sit and look at price action. So, and I didn't have any distractions, and that really, really helped. And the ability to focus and have discipline was probably the hardest thing, you know, um, because in the old days, if I needed 50,000 bucks for the weekend, I'd just pick up the phone and sell 50,000 bucks worth of stock. And people would just give me stock. Here, help me on my deal. Here's a million shares for free. So you get very, very lazy that way. And retail trading, you can't be lazy at all.
Hey JJ, a question. We're going. A lot's happening right now in the world. Interest rates in the United States are going to be going up. We have inflation going through the roof. We have the war over in Ukraine. How much, if at all, does that play into your trading? How you teach in the microefutures.com room, and just how you look at the TPO charts? Can you explain at all?
Sure. Yeah, definitely. Um, I was telling people in the fall of last year that the market's going to change after Christmas, because was the market was just a markup market. What happened was we just kept marking the market up every month, every month, every month up until December of last year, because we all know that Wall Street makes its money by bonuses. So people marked up the market for bonus time. January came, and the whole thing fell apart like a cheap suit. Now, this is the first time in markets. If you look, all you have to do is look at a candle wax chart, and you can clearly see, after we made those new highs after this move, When we made the big moves in this market, we didn't have any, when we were going up and up, there was nothing to the left here. There was nobody with a cost basis here. So now we finally have supply above us in this market. That's why it's trading differently than it did here or here, because there was no overhanging supply. Now we have supply. Now we have the threat of interest rates going up. We have political risk with wars. So we have to trade a lot more defensively now. And I always say, keep one hand on your wallet and your head on a swivel, right? We have to have really good risk management. Can't get lazy with our stops and move them around and things like that, because the large swings, especially in ES, an algo picks up a news headline, move might only last for 30 seconds. That move can be 10, 15 points, which is enough to stop you out and really cause pain. So we have to trade way more defensively now. The other thing is, for people who are trading equities, you just can't buy everything that comes across your plate and have it rip, because as soon as the market starts hoarding cash, or interest rates start rising, and we have you know a tightening of the credit cycle, all that free money that people were spending, it starts to dry up, and people will actually they'll hesitate now before pulling the trigger. I mean, last year we saw unprecedented emotional buying that I'd never seen before. People buying stock at $200 a share, think it's going to go to $100,000 a share, and when it dropped from 200 to 50, we're still thinking it's going to go higher, and buying more on credit. Now they're seeing that those things aren't working. There is supply and demand. If there's too much supply, there's no amount of demand in the world that's going to rip through that supply. And if you can't bring up that demand with cheap free money like the way we've been doing, you're going to have to trade a lot more tactically. That's what we teach. We teach tactical trading. That's our big thing.
All right, and this question, JJ, is really going to be for the rest of the group that's listening in, because I do not want to hog it with questions. But to the team out there, uh, you have a market maker, a 20-year ex-market maker on the line with you. Now is your chance to ask the questions you always wanted to know about the other side. It doesn't have to be about today's market environment. It could be any question you would like to ask. It could be about today's market and where JJ thinks it's going to go, but it could be any question that you have for a market maker that you would like to know. Now's a perfect opportunity for you guys to ask.
Hey, I can. It's true. Yeah. Now, I think poor lows. Well, I know that poor lows and poor highs. Like a poor low is a complete shut off of supply. Let's say there's 10,000 contracts for sale, and you get to that low. Uh, the wholesaler sees that there's no more sell orders coming in. They'll buy that, put that in their inventory, and the market will go up and leave a poor low. Now, a poor high is caused by the fact that we don't have continuation buying in this market, because 9 times out of 10, the buying in this market, every time the market dips, is caused by short covering. The shorts come in and cover, that stabilizes price, then longs start buying, the supply starts dwindling and the market goes up, but then it'll hit that poor high. And shorting that poor high is always nice when it happens, right? With a stop. The repair of that poor high, that might take a day or two given the order flow that's happening, right? So I don't work on trades that focus on the repair of a poor high or a poor low. I will only take the trade off of that poor high or poor low, and then I'll remember that it's still there, but it doesn't. I won't put trades into it because, you know, say for example, our poor high is 43.04, and we go down and trade 42.80. It's such a huge distance from that poor high that I can't really frame a trade around it. Does that make sense? Okay. Oh, remember, you have to, like, I don't know what your time frame is, right? Poor high, like say that 43.80, 85 or whatever that poor high is from Friday, right? That poor high, that might take a week or two to come back and repair it. It exactly, right? So those poor highs are telling us a poor high for me, just as a market maker, means that the buying has completely run out. It's just completely run out, right? And there's no follow through. Also have to remember that these markets are algorithmically executed. So they will stop to the tick as opposed to humans executing them. When humans execute, we have more excess, right, in a profile because humans' emotion, they're not going to stop right at a certain level. The other traders that push and cause that excess. That's why Stottlemyre's and Dalton's work is done in the 80s, and it reflects more excess and things like that, and revisiting poor highs and poor lows. But now we have electronic execution, so this market will stop on a dime. So when you have a poor high at 43.80, and we're trading 100 points underneath it, it's really it's good to note, like they say, carry forward, remember it for later. But at this point in time, it shouldn't really take up too much brain space. Mm. That's the big thing, especially remember last year we kept going higher and higher with these poor lows, right? A lot of people would get short thinking that they would come and get repaired. They didn't. Right? Just like a gap, just like a gap to the upside is a short position, right? So when you have a gap to the upside, and you have a short position, that's what that gap is. So we have to really, really watch our P's and Q's because sometimes those gaps didn't close for months.
JJ, one of the things that I've been wondering for a long time is what is the interrelationship between the different instruments? So, say for instance, SPY, either directional shares or SPY options, SPX options, and then options on ES. How does all of that affect the ES market?
I don't look at it at all. I come from the school of thought that you focus on the price action, inventory, and the order flow of the market you trade, the exclusion of everything else. If you start trying to correlate different markets, it leads to a lot of analysis paralysis. In my case, right?
So,
I trade the ES. I will not look at anything else. People will say, well, the NQ is going to do this, and the ES will do this, or how does the XPS, or how does the SPY correlate? For me, it doesn't matter. Those are great intellectual exercises for blood and guts trading. Like I look at trading as sort of like as trench warfare, right? So you really, and the other example I use is if you're crossing a street, look for the flow of traffic on that street, not on the one, not on a cross street, because you're going to get hit by a car.
So
Um,
what what I'm trying to get at is, say the market maker for SPX options or for SPY, do they hedge or take out positions in ES? As in, is there an
uh,
interplay between the two?
I can't speak to that because I don't have that knowledge. I was an equity market maker. I was never a futures market maker or an options market maker. So I made markets in equities solely. So that is beyond my level. I never ventured into that. And so I mean, but what you need to think about is how is that going to affect your trading?
Well, I suppose one of the things I've been aware of is the options gamma squeeze has an effect
Uh,
upon.
a lot of people do that, but here's the thing: where do you put your trade? Where do you put your stop? Where's the inventory? Where are you going to get in? Where's your out? Those are the things that I'm very, very black and white practical. Right? A lot of people love getting into this gamma thing, and I have nothing against it. We have lots of great options traders, and if you're trading the ES, I could care less about gamma. Right? I'm watching that price action. Like right now, ES is climbing from 42.96. Right? If we hold 42.96, we're going to go up to 4,300. If we haven't cleaned out 42.96, we'll come back under 42.92. Really, really simple. Right?
Hi, JJ.
So,
Hello, can you hear me?
We can hear you.
Okay, yeah, this is a question directly in relation to ES futures. I know you said you've been a market maker for stocks but not futures, but your current experience is with the ES futures. How do the market makers operate with their spreads in the moment of time? Like as you were talking about the current price 96 to 92 to 4300, how do they operate in terms of driving the market? Do they have any play in
inventory.
that?
Inventory. Now you got to understand a market maker only trades the order flow that comes in. See, market makers have a set amount of capital per instrument that they trade. Therefore, to be economically feasible, the business model is to trade against the order flow that comes in. So if you have a seller of 10,000 contracts with a certain limit price, we'll work that order. Like say a big client gives you a 10,000 contract sell order, right? We'll work that order. Otherwise, what the market makers do is they're just trying to make the spread between the buyer and the seller. They're doing so many millions of trades that it's just a volume business. They're trying to push as much volume through that tick spread as possible.
Hi, JJ. Uh, uh, Breven, are you done?
Go for it.
Oh, okay. JJ, I was
Okay.
wondering, do you think the ranges, we're getting larger ranges now than we got, a few years back on the ES? I'm curious if you'd mentioned things about liquidity changes structurally. Do you think that's going to remain the same? We'll have wider ranges than we had in years back.
Definitely, definitely. Because you'll see, I have something that I call greedy bastard day. And those are like those B profiles. And you'll see market makers absorbing 4, 5, 10,000 contracts at every single tick. And the ranges will be nice and tight. And there'll be a small range. Because if you're trying to buy a big position, you're not going to want to run the price up on yourself. So you'll do something called boxing a market. If I need to buy 5 million shares of stock, I'm going to do, and the stock say $5. Say you come and tell me, look, I want to buy 5 million shares of this stock. So it trades, maybe it trades 5, 10 million shares a day. It's not insanely liquid. You get me 5 million shares, and get me good prices. So I'm going to try and get your prices under VWAP. But what I'm going to do is immediately going to knock that stock down. I will start shorting that stock, just see if I can spook out a seller. Then I'll put a big collector bid somewhere, then a huge offer on top of it. When you guys see a big offer on the DOM, it's like the lid on the pot, trying to keep the price down so somebody can collect size at a lower price, right? So those are the kind of techniques we use. Now the problem is there's not a lot of big size traders and money managers in these markets right now because the ranges are so huge. It's very hard to put money to work. I mean, we have a podcast, Confessions of a Market Maker, and we have fund managers who come on that podcast. And, I'll ask them, what's it like trying to put size together in this market? And it's very hard. To put a 5-10 million share buy order together in a tight range. So we, because of the nature of these markets right now, and because market makers aren't really absorbing any kind of size, because they have to spread their capital. Think of the market as a piece of bread, right? And their capital is butter. If the bread is a small piece, so that you can coat that bread quite thickly. If the bread is a really big piece and you have the same amount of butter, you've got to spread it over a larger area, right?
Yeah.
So I think we are going to have this volatility and these kooky markets till we reach prices where large institutions step in again and start buying. And that buy and hold strategy. We're not seeing a lot of that right now because if you had 1 billion shares of Apple, I mean, most of these people have Apple. They've bought so much Apple, it's coming out their ears. Right? So those are the large stocks, and everyone's just got so much of it that they don't really not interested in buying it at the prices that they are. Right? We had a fund manager, who's a good friend of mine, Tony Duff, who used to work for Roger Rajaratnam. And he was a portfolio manager at Galleon, not at Galleon, but at Argus. And his analyst would say, at this price, load the boat on a stock. So when that stock gets to that price, those fund managers will step in and buy size. And they're just not really doing it right now.
And then just one other side question. I know you said sometimes you'll see a lot of liquidity come in, or there's a game that was played, a lot of liquidity come in order to move the market, let's say, down to accumulate. Is liquidity ever used? Sometimes I will see it finally come in, and that order will finally break the market down. Maybe it was just kind of jiggling around. So is it sometimes used as also a way to get the market moving in the direction someone wants, not just to accumulate, but to break it?
Well, those large shorts really aren't. In the old days, in the 90s, there were short sellers who had a lot of power. That would intentionally go and break markets. I know I used to do it all the time. I used to make a lot of money shorting. And in 2005, they introduced. Are you guys familiar with Regulation SHO? Regulation SHO was introduced in 2005. What that meant was you had to have a locate on a borrow unless you were in a market making role to short a stock. So that took a lot of the fun out of shorting. And because interest rates were so cheap, and a lot of the big short sellers just went away. So most of the selling that you see that breaks a market is usually just inventory. What happens is people get trapped long. Like you can take a look at the ES right now, and you can see that everybody and their dog is trapped long over 42.88. When we broke 42.88 now, it just it completely broke apart, especially 42.92 and then 88. You can clearly see let me just drag a chart in front of this. And you can even just look at a 1 minute candle chart. And you can see there's 42.92. So I'll look at a chart and I'll look to the left. So everybody above 42.92 is trapped long. The market went right to VWAP. expect there to be a seller at VWAP. So, if you were long 42.84, you should be looking to get out at VWAP. If you're long 42.92, VWAP's your exit, right? So, and then the people who are shorting VWAP, so they're looking for a break of 96. When 96 breaks, all of that inventory breaks out, comes down here, the shorts come in and cover. Then we get back up to 96. There's still trapped longs there, and that's what creates that selling that breaks 92. As soon as we break 88, all of this inventory is in question, and that comes spilling out.
Thank you,
So,
JJ.
no problem.
I have a question. How do you put your stop? Do you put it like James Dalton teaches, like based on structure? Or do you
I do. Sorry, I interrupt. Go ahead. Sorry.
No, and the second part was on average, what's your risk to reward ratio on average? Yeah.
I'm cheap. Okay. So what I like to do, and that's why I came up with these levels that you see on my candle chart, because now if you notice, you look at the stop, right? Let's take a look at a quick look at something here. So if you look at the market right now, right, the lower stops, like say you're getting long at 42.82, next structural stop is all the way down here at 42.70, right? That's where your lower stop is. And your upper stops are all the way up here. So it's hard trading profile and using the stops off profile. Each half hour bar is so big. What I'll do is I'll wait. Like, see how the market sold off here and we couldn't break 42.80? I'll wait till the market gets back over 84, establishes itself over 84, and then take the trade 84 to 88, and I'll put my stop at the bottom of that candle, kind of thing. Does that make sense?
Yes, thank you.
Right.
Um,
And
another
that's
question.
why I've been using a lot of candles lately. Go ahead.
I was just going to ask you about the London session and how the references work with, Globex hours.
They work really good, well, especially if the London session, if the Globex session is in the range of the previous day's regular trading hours, you can use the stops. You can use the structural stops from the previous day. If it isn't, I'll use my levels on these candle charts, right, to tell me where inventory is, right? So for example, so if I drew a volume profile from here to 72, you can tell exactly. You guys look at, I like to joke and say the high volume lymph node, right? You guys have these high volume nodes. I look at that as the position. So that means all of these people in time and volume are positioned over 88. When 88 breaks, you'll get a lot of this position come sell out. And we'll look to see the next lower position is down here between 72 and 76. So you see how it's sort of just kind of stopping here and it won't print 80. So when it's doing this you guys call this consolidation, call this cleaning. Right now we're cleaning 80 to 84. If we completely clean 80 to 84, we'll get over 84. So this is a period of time where I'll sit and wait, trade. Right? And then once it clears 84, so say I missed the 84 trade, we can look to see if I can get 84 to 88 to 92. Right? See how it's cleaning, and there's still supply. Right? There's that high volume node. That's the supply. All of these people now are trapped long for 42.84. If we take out 42.80 and we start taking this chunk of people for swing longs on a larger time frame, not swing, but a longer time frame traders, because this is just a 1 minute candle.
Got it. So it looks like you use both volume profile as well as market profile.
Yes, I do. Volume profile, it's like a Reese's peanut butter cup, right? They work really well together. Peanut butter and chocolate. volume profile and market profile, because the market profile shows you the structure. It shows you how price reacts when it gets to a certain level. You can clearly see when it takes a level and comes back up over it. You can even separate it out and see exactly how much printed down there. Right? You can see exactly how much volume is printing. So now you see a buildup of volume here in this G and H. That's short covering. That's all short covering, because as soon as a market moves down, the shorts come in and cover. They're the canary in the coal mine. If they see supply, they run away. So that's a cover right there. Anytime you see size at the bottom of a profile, those are shorts covering first. And as soon as longs see price stabilization, jump in and you'll see this happen. Now, if all of that inventory has been absorbed here, the market will get back up to the H high.
Got it.
Hello again, JJ. I was wondering, is there a minimum trade value that you look for in entering a trade from a level to a level?
In like value of
Yeah, number of takes, points.
I generally I like to trade for three in this market. What I like to do is I like to take these big ranges, chop them up into 3 or 4 point trades.
Yeah, I think you mentioned that earlier, like 3 to 6 points, I think. Yeah.
3 to 4, depending on the price action, 3 to 4 points, 3 to 6 points, because that way it's digestible. You're
Gotcha.
not betting the whole farm. And if you have a 60-point range, and you've got 23 hours to trade that in, so you can do 2 or 3 trades, go for a walk, come back, and then look at it again, sort of thing. It makes it
Right.
digestible, right?
This one, which software is this? Which platform?
Sierra chart.
Sierra, thank you.
Yes. Yeah. 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 You know what? You won't believe this, but the people who have been in my trading room for the last few years have seen it. When the contract rolls over, it will still respect those levels. Now, here, I'll show you something. It's going to freak you out. There's one chart here that I have that is. See this chart here? These levels I've had since the ES was down at 2000. And they've been with me through contract rollovers, all sorts of stuff, and they still work. Sometimes they work to the tick. It's mind-boggling. When the contract rolls, it will still respect my levels. What I do is I will use continuous futures contract date rollover. That's how. Yeah. Oh no, I at first I thought I had to do that. So one day, I think what it was, I was just lazy once and I didn't do it. I was like, hey, it worked. And I just kept. What I did was, and it's just ridiculous. Like these levels here, right? And it's just these levels are from April 2020. The other chart, those levels are from when the ES was round down 2000. I just came up with a balance area and doubled it, and kept doubling it and doubling it and doubling it, and the market just kept going to these levels, and it was just just freaky, and it's not complex math at all. I have videos that in our room that show people how to come up with these levels on their own, and it's the most amazing thing when people come up with these levels and they're like, "Holy cow, JJ, it actually worked! What the hell?" Oh, it's really really odd. I'm sure there's some fancy mathematical reason why it works. I've heard people compare them to Darvas box, but I've never traded off Darvas boxes or anything like that. So, my pleasure.
Hey, JJ, how you doing? Yeah, I have a question, JJ. When you enter long or short, do you care if you're entering above or below the value area?
Not so much anymore. It's all about inventory. Right? Because the thing is, these value areas are huge. So I will short when I see inventory piling up. Like if I see inventory stuck between 88 and 4,300, right? Then when it breaks 88, I know to get short because then I know that we'll have supply. Because really, guys, trading is just supply. If there's supply, we can short. If there's no supply, we have no business shorting.
I see. So basically, you will enter at any level, wherever you see supply or
Wherever I
period.
see supply, or whether if I see a lack of supply, that's when I go long.
Okay, it doesn't matter where. Okay, that's perfect. And do you recommend trading based on the market profile only
It's
without
it's
using
harder
any
to.
type of chart?
When I first started, I never had a candle chart. I would kick people out of the room for using candles, right? And then Steve said, "JJ, you can't." Then my girlfriend trades candles. This is how I got into this whole candle thing, right? Now, before I would just have profile and I would trade solely off profile. Then when the market started getting these huge ranges, profile was harder to trade because the stops were so far away. So, and it was harder to see the inventory. So I came up with these candles, and my girlfriend, we've been together a year and a half now, and she started coming up, she started with these EMAs and SMAs, and now my charts look like, I went to Bed Bath and Beyond. There's candles everywhere, you know. It's pretty funny. The guys in my room really they find it funny. I think you can use the concepts that profile teaches, apply it to a candle chart if you know what to look for. I always until about 6 months ago, I've been looking at candles all wrong. I was trying to because you're trying to memorize these patterns and emojis and all this sort of crazy nonsense. All you need to do is look at where the supply is and where the supply is running out, and the candle will show you that. Maybe throw like on this 1 minute candle, I have the 7 simple moving average, and it works like a charm. I like
Yeah.
simplicity. Market makers and guys like us, we like keeping things simple. Like I don't use any indicators or anything like that at all. Like I mean, once I
What about liquidity? Do you keep an eye on liquidity, city liquidity, like where there are more offers or bidders?
on the DOM, I could care less because no. See, the thing is, my friend, no trader. If say I'm an ES trader, right, and I have friends who run prop desks and or ex Goldman traders and things like that. We have a friend of ours who's been in the room. He trades 10, 15,000 e-mini contracts. Right? And he'll never show his hand. See, a job as a large trader is to come into market, take 15, $20 million out of it, and you don't even know he was there. That's what real trading is.
All right. All right, perfect. Thank you. Thank you for your
Yeah, no problem. No problem.
Hey,
JJ.
JJ, just one quick question. Who's your broker?
I use AMP Futures and Iron Beam.
Okay, thank you.
Simple, just Sierra chart with CQG.
JJ, Jim Dalton talks about tempo I've heard of terms like velocity, like the speed of, which is the speed of trade, whereas tempo seems to be just kind of the movement back and forth on his TPO chart. I'm curious if you find those things helpful.
And what I do for tempo is I'll just go and open up a time and sales window, right? And I'll just sit there. I'll just look at the speed of the tape, right?
Mhm.
Because like on equities, looking at the time and sales is very useful because the tape tells a lot more than futures. Because in equities, you see things like price improvement, backfilling. I can look at the time and sales on a stock and see if the seller's an offshore seller, onshore seller. I can see if they're price improving off the bid, things like that. On futures trading, there's no wash trading or anything like that. All I'm doing is I'll just have see how it's stop and start and it's not continuous, right? So that's just telling me that the order flow is not consistent, right?
Mhm.
These markets these days, we don't have, for you fluid dynamics guys, we don't have laminar order flow. We have turbulent order flow in these markets because a large order will come in, market makers will deal with it, transact it, it stops, then a little bit of small orders come in. It's not smooth. So that's what I consider pace. I'll just look at
Yeah.
the tape and the tape is slow today, right?
Yeah, that makes sense.
Yeah.
So, JJ, you're referring to where the supply is.
Hmm,
Could you talk a little bit more about how to identify that?
sure. What I'll do is you can use a volume profile with a candle chart if you like, or hang on, just let me. So, for example, as the market came down here, right? This was an area where we had some short covering. It came down. So as the market came down, we had supply all day in this thing. I'll use a 5-minute candle. So right here is a perfect example. If you look from last night's Globex till the morning open, there is supply between 43.12, 43.28. So that supply was taken and sold at higher prices because that's what wholesalers and large traders do. They took in supply at the end of the day, sold it through Globex, a nice little move up, pushed out all of this garbage, sold it, broke VWAP, came back. Now, when this market broke VWAP, I know to take a short because there's supply above VWAP. Right? But when it breaks this 43.12 level, like I was telling our room today, should be shorting 43.12 because all of this supply. You guys see that?
Got it.
You got VWAP and you got supply in these boxes. And as soon as you start taking out that low, all of this, will start falling out. And then we had short covering around 10 o'clock in the morning, took us all the way back up to VWAP. It's seller at VWAP again, and now we're back down to new lows. What this market is trying to do is it's trying to find the bid. And what that means is it's trying to find a place where Dalton says two-sided trade can occur. And because we don't have a lot of institutional participation, i.e., from money management companies, we have these big ranges. I'll look at a 5-minute, and for you larger swing traders, what you can do is you can go and take a look at a 4-hour candle. And for example, if you were a swing trader, a 4-hour time frame, these candles here, I was saying there was supply above 44.40. Every time we came into 44.40, there was responsive buying. As soon as we broke 44.40, right, all of this inventory from January 31st came spilling out. Shorts came in and covered. And there's that 44.40 again. Inventory gets long and trapped with no upside continuation. Once it takes out that low, then you have this, and then once you take out swing lows, and I call these pinata lows. When you take out those swing lows, all the candy above starts falling out. That makes sense.
Thanks.
Yeah, no. Now that's a different story because there's a news event surrounding how that poor high was created, right? News event is earnings, right? So what you do is you short that poor high, but you know that there's a news event coming, so you would trail your stop, right? I am a big advocate of getting paid. You know, it's really nice to say I made 40 points on one trade, or I made the whole move. I like I like every week to have money in the bank, right? I'm not. It doesn't have to be glamorous, right? If you know the Oakland Raiders in the old days, Al Davis would say, "Just win, baby." It doesn't have to be pretty, and that's what we teach people in our room. Is you know, if you make 3 to 4 points, 3 contracts on the ES, do that a couple of times a day, it starts to add up, and you can pay your rent, you can pay your bills. Yeah, you're not buying private jets, but for new traders, it's a great working start because most traders aren't profitable. Right? We really, really emphasize trading for income. Right? So it's not as glamorous as they're not the Lamborghini trades. They're the trades that pay your rent, pay your bills, and allow you to sleep at night. Yes, anything that has a structure to it, right? Because all market profile is just taking the time and sales and putting it into a two-dimensional format so the human mind can grasp it. Otherwise, you're just watching the time and sales scroll, right? It just takes all those transactions, and then the shapes help us identify what's going on. So a poor high means buying exhaustion, trap longs, take the short off of it, and then what you do is you look for the next set of stops lower. So say the poor high is at $5, right? The next lower stop structurally is 450. So you short 5. If the market can't get past 450, you know that there's not enough supply to break those stops. So you got to get out of your short. If it breaks 450 and the next stop is maybe 375, carry forward and look to cover at 375. The way I teach people how to trade is where you put your stop, then not only once you're in the trade, but how do you manage that trade, maximize your profits, given the market conditions you have. So you know how to align your expectations with actually what's going on. Makes sense. Yep. Oh, okay. Yeah. I don't look at delta at all. Right. Delta is one of the most misunderstood concepts in trading because traders buy on the bid and they sell on the offer. So sometimes a market could be going up and the delta could be negative because they're just pushing the bid. It's just one of those things that causes analysis paralysis. Right? Now, some people like it and they use it, and if you can use it well, if you understand how order flow works, if you understand how big orders are traded, it's different when you work 1,000,000 shares of a stock versus trading 5,000 shares of a stock. So your delta is going to change. If you're a large size trader, what you do is you bid the market and you let the stock. You know how Dalton says, let the trade come to you. He's meaning is put in a bid and let the price come to you. Let the sellers come to your bid. And if that bid sees a lot of selling, you drop the bid, offer in front of the seller, and push that seller into your lower bid. Right? That's going to affect your delta. Well, not you, because you don't have the size to do it. But, I mean, if you're trading 20, 30 million shares, yeah, then you have the size to move markets, right? We are not size dynamic traders. We are retail traders, and we depend on those large traders to move the market. Right? We can't move the market. Right? So those traders, when they do those kinds of things, your delta is going to be hard to understand. It's hard to trade off of. Right? Just look at where the inventory is, how it reacts when it gets to a level, and if you simplify your trading, it's going to be a lot more profitable. Less things you look at, the easier it is going to be to execute, and the higher profit ratio you're going to have. My pleasure. Guys,
Yeah, it's all good. I mean, it's a great session. I think I've enjoyed. I anyways enjoy JJ your tweets. I mean, one thing that I used to do, as you mentioned, shorting, looking at poor lows. So those things I
oh
learned from your tweets. That that is like a sort of as you mentioned that supply being shut off. So I
oh,
used to be very careful. So since then, I actually started buying the poor lows, and some of those poor lows has acted actually like a big lottery, because
yeah,
your risk is very
yeah.
small and your reward could be huge.
As long as
And
that poor low holds, you're good.
absolutely
You're
no,
golden. You're golden.
no, no. I mean, I had a discussion with Sampath. He's our young trader in the room. So quite a lot of time. Because the way that I mean, James Dalton explained, right? I mean, see, one thing that I learned from your tweets is risk management, which
Yeah,
JD has a different perspective, right? JD don't care about stop loss because his time frame is probably 2 to 3 days. Sometimes as a day trade, but he gives more importance to the structure. So
yeah.
uh,
And he
yeah,
trades
so
options, right?
yeah, absolutely. I mean, he does
The
a little bit
futures.
futures as well, but I think he sort of hedges sometimes.
Yeah.
Yeah,
There's so many ways to peel the orange.
true, true.
Whatever works for your lifestyle, your risk, your account size. But the main thing is, just to we like to have, like fighter pilots, we like to have situational awareness of what's going on in the market, so we can actually take advantage of it. And that
Yeah,
way it keeps us out of trouble too.
absolutely, absolutely.
Stuff.
Yep. Anybody has any question to JJ?
I, I oh yeah, I do. I mean, I'm looking right now, and we're right underneath my 4264 level, and if that breaks, I'm looking at that, basically looking for 4194, and if that breaks, I'm looking at 4124. Those are sort of the kind of levels I'm looking at, because that's really the last kind of trading range we had was back in April of last year, when we had sort of a 4124 to 4229. That was the tightest trading range we had before things went crazy, and this thing just kept one time framing higher and higher and higher. And every liquidation break was just inventory correction. There was no real selling. This is the first time we've seen any real selling in this market in quite some time.
Yeah, it's
It's
quite
healthy.
consistent every single day.
It's healthy. This is healthy. This is like
Absolutely.
it's not good for markets to do. This market was being held up by massive short positions, months and months and months, and we have gaps going back to April of last year that still haven't filled. You know, that's not healthy for a market.
That's true.
Uh, I'm seeing 41 and 24 is one of the areas. Definitely that 41-24 area. I don't very careful about prediction because I created order flow and I'm an order flow guy. I let the market tell me. So I mean, so if you're trying to swing for the fence on a short at 42.60 to 4,000, if you have the capital, sure, right? But I'll wait till we get to 41.24 and see how it behaves. Right? For me, every market level is only as good as the order flow that hits it. The order flow hits it, then I can tell more. Until you hit it with some order flow, we have no idea what this thing's gonna do. Oh, my pleasure.
Thank you very much, JJ.